Okay, so let's begin. So hello everyone and welcome to another session in our masterclass series. I'm Sapna Patel, part of the large corporates FX sales team at Lloyds, and joining me today is Jethro Hancock, who heads up our funding market sales desk. So today we are going to use the next 30 minutes or so to cover repo and money markets. As usual, to keep the call nice and clear, we've disabled cameras and microphones. If you do have any questions during the call, then please feel free to put these in the Q&A chat function, and we'll look to answer these at the end. And worth noting, if you've got team members who can't join today, a recording of the call will be available on our website tomorrow, and we'll share the link with you once this is live. So let's kick off. So Jeffrey, do you want to take a moment to briefly introduce yourself before we get into the detail?
Sure. Thanks, Sapna, and good afternoon all. So I'm Jethro, work on the funding market sales team within our financial markets area, so one row away from Sapna, and we do the sales activity for money market and repo products. So that includes raising deposits for both Lloyds Bank PLC, the ring-fence bank, the retail bank, you'll know in the UK, its treasury division, and then the LBCM, Lloyds Bank Corporate Markets, which is all the bit of the bank that couldn't sit in the ring-fence bank post-ring-fencing regulations. So it's raising deposits, doing CDs, CPs, doing repo, and then we sort of get into sort of asset and liability management for both banks as well. So we've got a treasury and ring-fence bank, a treasury in the non-ring-fence bank, and a repo trading desk in LBCM.
Great. Okay, so let's start with the basics. So Jeffrey, what is a repo?
So repo is short for repurchase agreement, and the easiest way to think about it is it's secured borrowing and lending. Normally it's sort of the financial markets equivalent of a mortgage. So you're normally secured against a house in our case, and that might only get marked to market every sort of 3 to 5 years as you might look to remortgage. In our case, it's secured on securities, and at Lloyds, that's investment grade credit. So across sterling, dollar, euro, yen. So that includes covered bonds, asset-backed securities, and then senior unsecured investment grade credit. And the majority of what we do it on against is government bonds, and being Lloyds, the majority of the issuance of government bonds is the UK government. So back to the house analogy, rather than it not being marked to market regularly, a repo is marked to market every day. So if the bond versus the cash has moved in value, then there's an interest payment or margin payment rather from one counterparty to another. What that means is the economic benefit of the collateral remains with the person who has repoed out the bond, but the legal ownership has changed, so title transfer. We can kind of get into the details of legally what this means and from a credit risk perspective, but broadly speaking, what is a repo? It's secured borrowing and lending.
Great. Okay, so that makes sense. Following on from that, why is there a repo market then? What do we see counterparties use it for?
So for us as a bank, we have a series of reasons we use it internally, and then obviously we sort of try and do, because you've got a cash giver on one side, a cash taker on the other, and collateral moving delivery versus payment against those cash legs. We've got an external counterparty on all of our transactions as well. So for us, GCT there is our group corporate treasury firm. So they will use it as part of their liquid asset buffer. So if we've got corporate treasurers on the line, we can sort of discuss how we use repo ourselves as a group corporate treasury. And then we've got the other three broadly linked together, which is the GEM is gilt edge market making desk. So that's where we're buying and selling on an outright basis UK government debt. And credit trading is the same equivalent, but for credit product. And the firm financing of that business is essentially when you're long a bond, to fund that position, you'll repo out the bonds to raise cash for that bond purchase. And then vice versa, if a client wants to come on and buy a bond that we're currently not holding, the credit trading desk or the GEM might choose to go short to facilitate that client flow. And the firm finances or raises that, that covers that short via the repo desk. So again, repoing out longs, raising cash, and covering shorts, lending cash. So that's internally how we use the product. And then the sort of clients and who operate within the repo market. So LDI is liability-driven investment, which is UK pension schemes managing their future liabilities. And then yourselves, predominantly on the call, so corporate treasurers managing pools of cash and liquidity. And then that flows through to commercial banks, central banks, the hedge fund community, and another big cash provider would be money market funds.
Okay, great. So this is typically a product that we would see a large majority of our institutional clients use. But as you've alluded to, how can our corporate treasurers think about using repo alongside other money markets products? So I guess from my understanding, I gather there are two perspectives which we can look at this from. So one being a risk management perspective, which looks at things like funding and liquidity, again, which you've touched on, and the other being to generate income, so primarily cash and collateral optimization. So could you talk us through those?
Yes, so I guess on our desk we cover everything from the deposits that will be raised that you might, corporate treasurers might be traditionally more aware of as a product, through to CDCP. So, there's a certain amount of, deposits that you might want to place with your banking panel, and deposits are treated favorably from a liquidity perspective for banks, because they get given a favorable treatment in terms of behavioral life. It tends to be part of a wider banking relationship where you might have lending or foreign exchange lines. Primarily I would say the first port of call for thinking about a corporate treasurer's cash pile and what you're going to do with it would be placing deposits with banks. I guess the next part of that is, well, you can do CDCP, so certificates of deposit, commercial paper, where now in the world of securities, where you can transfer that paper from owner to another buyer, without having to go back to the bank and say, actually, I need the deposit's maturing, I don't want to roll it, or I would like to early terminate a deposit. So that gets less favorable treatment for us as a bank because of that ability to buy and sell the paper. So again, that is reflected in the interest rates we're willing to pay on raising that cash. But you could argue you've got greater liquidity on holding those instruments rather than the deposit. And then I guess you get into have you got enough of a cash pile that you might have placed as much deposits as you want with banks, and bought as much commercial paper as you want from banks because they're predominantly the issuers. You want other exposure or credit risk, and then so you might want to do a bond portfolio. You might want to buy covered bonds, asset-backed securities, senior unsecured paper, which might that then brings in the secured nature of your cash placements. and also brings in a load of new issuers who might issue senior unsecured paper rather than they might not have a commercial paper program. So I guess the thought process we were thinking of with the corporate treasurer might be that progression from traditional placing of deposits through to owning a bond portfolio. Now, I guess the follow-on question to that, Sapna, might be, where does repo fit into that?
Great. Okay, fine. So that's really clear. If we move on to talking about the logistics, so what are the requirements to be set up to partake in the repo market? So everything, I guess, what is needed from an operational perspective, a legal perspective, and then specifically to trade with Lloyds as well. What do our clients need to know?
Yeah, so it's when you look at that suite of products, the deposit, you can pretty much just set up an account and place the deposit very quickly. The issue with repo would be that there's a series of legal documentation. So we call it a GMRA, Global Master Repurchase Agreement, which is very, very similar to ISDA. So ISDA for derivatives, GMRA for repo. So you would need either your own internal legal department to opine on that standardized industry document or take external legal opinions. So there's cost involved in that and time. Operationally, we've briefly discussed it, but you place a deposit, it sits there, you get principal and interest back at the end of the maturity. For repo, the benefit is you're secured, you've got a piece of collateral, but that has an increased operational burden, which is you have to mark to market value and margin that transaction every day. And you have to be able to settle via your custodians both the principal and margin of the transaction. And then I guess finally, less of a point, but you got to think about with those other products, you are operating in a different market. So what are the sort of specific liquidity issues that you might face within a repo market versus the rest of the money markets?
Okay, fab. So, I mean, we've gone through a very quick introduction to repo and money markets. And more so, obviously, we focused on this call how corporate treasurers can use repo when considering looking at their treasury policies and approach to cash management. So I suppose a few questions from me before I kind of look at the Q&A. In terms of credit risk mitigation, should I say other than credit risk mitigation and the yield benefits, what are the other benefits of looking at a secured versus an unsecured product?
Yeah, so it's a really good point, and I think if we think of some of the corporate treasurers who are currently using repo, you have the ability. So, so for example, here we've put, in fact, yes, if you jump to that slide where it says gilt repo, if you have cash and you're thinking, okay, well, I will do a repo, receive gilts as collateral against it, and I'll compare that against the yields that I'm getting on my cash in other money market instruments. It probably doesn't look that attractive. So we've got SONIA, spreads to SONIA there in the sort of low single figures from a 35-day evergreen out to 1 year. And then the sort of yield you can get if you take lower quality collateral, so investment grade corporate bonds, it gets higher. And the reason for that is that when we're financing that collateral on the other side with clients, we charge a higher repo rate for that financing, so we can pass some of that through. And I won't touch on unsecured bond borrow, but if anyone's interested in the details of some of these other transactions, then we can discuss that after the call or in the Q&A. So the benefit isn't necessarily, the benefit initially is exactly like you mentioned, Sapna, that you're getting a credit mitigant, that you're fully collateralized, by a gilt, say. So, you might be comfortable to place, if you've got £1 billion of excess liquidity, you might be comfortable to place, up to 500 million with 10 different banks and spread your counterparty credit risk that way. But then if you're at 10 billion, you probably don't want to, have a vast banking panel and placing all of that unsecured. So I think a lot of people use repo for that excess cash over and above that. So that's one benefit. But the other benefit, I guess, is, and if we jump to the next slide, obviously once you've got that collateral, you place cash unsecured, you don't have any collateral that you receive back. Once you've got that collateral, you've got the right, as we talked about with legal transfer, to rehypothecate or reuse that collateral. So let's say you have margin requirements at a clearing house or with your bank panel on under the ISDA, under a CSA, or for your foreign exchange or interest rate hedging, then you can use that collateral rather than cash as initial margin and variation margin. So then you start to get into the world of collateral optimization, and that's where I think when it hits a scale, clients find a lot, or corporate treasurers find a lot of benefit in using the product. And I guess once you've started to use that, collateral optimization, you can then start to optimize your funding and liquidity. So here we've given an example of the yields you might get if you were able to buy a bond portfolio. So rather than just holding it in those traditional money market instruments, including repo, as we've talked about as an investment, you could actually go away and buy the outright bonds. And as you can see, the yields across various tenors and different types of highly rated collateral are significantly higher. And then I guess probably where we'll go next is, okay, but if you've got this portfolio, how can repo mitigate your risks associated with holding that portfolio?
Right. Okay, that's really useful to know. And I guess, you alluded to us as Lloyds Bank and our group corporate treasury team using repo on a day-to-day basis as well. So I guess in more detail, how do we actually use these products as a bank? So I know we're obviously considered a financial institution, but I think it'd be quite useful for everyone to know what benefits we kind of derive as an institution from using the repo market.
Yeah, so if we think about how we've talked about, bond portfolios, money market products, cash held at banks, that's how we think about it as a treasury. So if we think of the larger retail and commercial bank treasury, it's about 125 billion of liquid asset buffer, of which it's broadly split a third between cash held at central banks, cash used to buy a bond portfolio, and cash deployed in reverse repo. So that's how we think about it at the broadest level. And then I guess you have to think about, okay, well, if we've got a third, what do our outflows look like as a bank from a liquidity perspective across currencies? And therefore, how do we use those three different asset allocations to make sure that we are optimizing our potential outflows that we have across currencies?
Okay, fab. Right, so we do actually have some questions on the Q&A as well, so I'm going to turn to those now. So the first is, what type of margins are we seeing on top of Bank of England base rates for repo at the moment? So just a range indication is what's being asked.
Yeah, so if we jump back to that one. So yeah, you'll see. So as a spread to SONIA, you're seeing, like I say, single digit spread and then depending on where the SONIA bank rate basis is at the moment, which is probably sub 5 basis points, you're looking at that kind of spread. So it's probably broadly equivalent to what a money market fund would be paying. But like I say, the benefit here being that you've got a piece of collateral that you would be able to use for margining purposes or elsewhere within your sort of liquidity management. So it's probably, if you're looking for a pure yield product, like I say, the treatment of deposits and placing deposits unsecured is probably the first port of call for the greatest yield. But if you've got a level of cash that you want to start to mitigate your counterparty credit risk exposure, and then also start to look at collateral optimization and potentially being able to buy a bond portfolio, then repo could start to be an interesting tool for that.
Okay, great. And another question that we've had through, more from a logistical and kind of operational perspective. I understand there is a simpler way of trading repo with you rather than negotiating an individual GIMRA. Is it the CRCs?
That's great. Sounds like we've got some of our tri-party providers on the line. And yeah, that's a really good point. So rather than a classic, an entry level for a classic corporate treasurer would not be, so where it says operational, bilateral repo, where our operations department and your operations department have to do that mark-to-market margining and settlement. You can outsource all of that to a tri-party agent. So major providers are Clearstream, Euroclear, and Bank of New York Mellon. And essentially, they do all of the collateral management on your behalf. So that takes away the operational burden day to day. And I think they've got it down to about 3-minute cycles now. So every 3 minutes, the collateral versus the cash are mark to market and margin. So it's incredibly safe in terms of how secure your cash deposit is. And from a legal perspective, they've actually made it really simple as well, in that rather than you having to go, like I say, to external legal counsel and spend months, if not years, negotiating legal documents with, let's say, your bank panel's 3 or 4, or even your bank panel might be 15 or 20 banks, you can just sign one document, CRC being Clearstream's repurchase conditions, and Euroclear have a similar product, and it's a standardized legal document that once you've signed it, you can face all the bank panel who have also signed it. So we've signed it, so you'd be a one document, and you can face I don't know, up to, they've probably got 50 banks on that under that documentation.
Okay, that's really useful to know. I mean, anything that kind of lessens administrative and documentation and kind of all that kind of burden is obviously most welcome, I'm sure. I've got another question from me. So could I just ask from a logistical perspective, when you enter into a repo transaction, what are the kind of key steps that happen at maturity? So operationally, how do you kind of settle a trade, so to speak?
Yeah, so if we go back to maybe the first slide we shared of what's a repo, it very, very straightforward. So let's say what are we doing in this case? The customer's actually giving the collateral, we're lending the customer cash. UST being there is talking about the 5-year US Treasury bond. And then what happens at maturity? So we will redeliver that bond back to the customer. The customer would, because they borrowed cash, they'd give us back the 100 million plus the accrued interest on the repo. Like I say, bilateral is delivery versus payment. So the bond would be delivered versus a payment leg, and they pass simultaneously, so you don't have any daylight settlement risk. That's daylight settlement risk. So that happens once a day in bilateral. And like I say, the tri-party agents have reduced that risk down to 3-minute cycles.
Okay, great. Right. So I think we're close to the end of our session. So Jethro, thank you. That's been really useful. Another topic that we've covered in this series, so repo and money markets. We welcome all feedback, everyone. So if you do have any other thoughts or suggestions for other topics, then please do let us know. You can also sign up to the mailing list on our website to receive these monthly invitations straight to your inbox. But other than that, Jethro, unless you've got anything further to add, I think we could probably leave it there.
Nothing to add other than thank you for the invitation, Sapna, and anyone who wants to talk about this product or who's interested in it. We play a reasonably important role in our niche of sterling money markets, including repo. And so we're more than happy to create an ecosystem where as many counterparties are involved in gaining the benefits of that market as possible. I think if we think about what's happened from going from a low to no interest rate environment and maybe regulations post 08 where there wasn't the requirement for daily margining requirements of under ISDAs and things like that, to a world now where we've got much higher interest rates and what we've noticed across the major jurisdictions, if we think about Europe with Credit Suisse, we think about the US with SVB, and we think about the mini budget volatility in the UK, what should be in the front of people's minds is liquidity. And how effectively to manage their liquidity as well as possible, and repo is certainly a tool that will help them with that.
Excellent. That's great. Thanks, Jethro. There are a few questions that have come through on the chat, but what we will do in the interest of time, we'll address those offline, if that's okay. If anyone does have any further questions, then please feel free to reach out to either your relationship director or Jethro or myself, and we'd be more than happy to get those questions answered for you. But thanks for dialing in, and until next time. Thanks, everyone.